Hi, this is Tom Nunemaker with Capital Discussions, and this is my trade review for July 22nd, 2014. And here's the 3-minute chart of the SPX today. So we gapped up. Actually, let me bring up a 2-day. 2 days, 3-minute bars. So you can see we gapped up and stayed up all day, rallied, sold off a little bit, and then recovered most of it. Closed at 1983.35, up 972 or 0.5%. So all in all, our options are doing pretty well. So if we look at option view, I've updated the price. Actually, they've just changed a little bit. It's just a few minutes after the close, so their options are still trading. So I'm going to just update these with the current prices, and now it's 560. Okay, so according to this, we're up $448 right now, and delta, gamma, theta looks pretty reasonable. Analyze chart is here. Let me just check the volatility. So at the money, put vols 9.9. So let's just bump it up one just to be conservative. And here's our expiration standard deviations. That's 2 standard deviations. And if we go t plus 16, which is halfway to expiration, we're pretty good shape. Option view is saying a 98% probability profit. And we'd like to get up in this region here. Even here, the P&L, if you look right about here when I have the mouse clicked on this little wand, it's 1889, 19, 2000, 2100. So we can get some nice profit if it sells off just a little bit. And it could. If we look at the price chart on a daily, let's do a 3-month daily chart. It could easily pull back a little bit, don't you think? Maybe 1960, 1950 range. If it hits 1950, it might go lower, and that would be okay. We're good down to maybe just under 1900, but really having to do much. So it hasn't been in 1900 since May 23rd, so quite a while. But the chart looks pretty good right now. If it keeps rallying, I'll just start peeling off some of this, or maybe add some more put spreads. So I could do something like do this if I wanted to really be aggressive. So kind of the general rule of thumb on verticals is if you go from high to low, so positive to minus, that's not the strike, just the sign. So plus to minus, that's a bullish position. Plus to minus, that's a bearish position. And my plus to minus, this part of the trade is bullish, this part of the trade is bearish. So here we would be adding a bullish vertical. And you can see what it does to the risk graph. It raises it up here, but lowers it until we pick up the long put here. And you could even do it something like this. So that spread costs about $700. So we would still have a credit right here. So at expiration, this makes like $20. So that basically is, you're not going to lose, but you're not going to make much of it. It goes right here. But notice on the T plus 16 line, you're fine. So that's actually a nice profit of $1,700, $1,800. And it raises up the expiration profit here to 2,000. So if we keep rallying, that would bring in a little bit more cash. So that's one thing you could do if you were still bullish on this. And we'll just leave it alone right now. Right now we're short, our main shorts, our 21 short puts are at 14 delta. They started out 19, so you can see that the market's already rallied a little bit. And naturally our time window is shrinking, so now we've got 32 days to expiration. So tomorrow, look at this monthly chart again. It looks like it's trying to break out of consolidation. It tried. I don't know if I can draw trend lines on here or not. Let's see. Edit chart. Okay, there we go. So if I add horizontal trend line here and a horizontal trend line here, okay, so this is kind of our consolidation zone. You see it's bumping right up against that, but it didn't penetrate through. So it's still kind of going consolidation. So you'd expect it to go sideways, maybe sell off, a little profit taking into this 1951 area. So as long as it stays in there, I would consider it consolidation. If it breaks up, this could be a bullish sign. Then we might want to do something like adding those bullish verticals. If it goes below this, we would want to address that and probably go try and grab some negative delta. And we could do that by simply just doing a bearish spread like this, just adding another one. And what that does is it, let me just go to the existing. So here's what we have now, and then superimposing, oh here, let me do it a different way. There's existing, and I can use this to step backwards. There's the proposed one. So those are the two, and now we can superimpose them on top of each other. So we give up a little bit of profit, and then it raises everything else on the downside, as you would expect. So if we do start selling off, that's probably the first line of defense, or maybe just even buying a put, depends on how delta negative you want it to get. Now that would make you 22 delta, and it drastically cuts down the Vega. So notice if we just do the trade by itself, you can see that it's 37 Vega, positive Vega, and minus 8 delta. And if we do both together, you can see the effects there. So you're reducing the effects of Vega. With that spread, with the long put by itself, it's got 198 Vega, so quite a big dose of Vega that takes your Vega way down and gives you a little bit more negative delta. So that actually puts you here, or actually you still make money, believe it or not. So today I could put that, I could just buy a long put, and basically I would just pay commissions for this to keep this trade on. But it gives you, a nice risk profile on the downside. You're protected at the T plus 16 all the way down to 1876, which is a 5% drop in the SPX, which is pretty big. So those are a few things you could do or think about, depends on what it does, but we'll just be watching this consolidation area and see what happens. I have a feeling it might break out because it's trying to, but it could easily just stay in here too. That's probably the most likely. So that's about it. If we can, I know we can check our Greeks here. So if we pop in the data, 1983, 35, and the vol, we'll use, let's do 12 again to be conservative. The delta, 0.27 minus 0.11, 61.82, and minus 277.6. Now, strictly speaking, you don't really need to use that negative sign because it takes the absolute value for those ratios. And I did calculate it, didn't I? Yes. Okay, so our theta to delta ratios are perfect. Vega to theta is pretty nice looking. Theta to delta is nice looking, again, because the delta is so small and flat. And you can see that, if delta is 0, the line is flat. Well, that's pretty close to 0. It's very, very flat right here, which is exactly what we want. Now, if you click on the line, you don't see the standard deviation bars. And why is that? Because the time is 0, and time is part of your standard deviation calculation. So if you right click on here and go T1, that's tomorrow, and now you will see the standard deviation. So that's one standard deviation for tomorrow, and we're obviously in pretty good shape. So that's pretty much it, and I'll update you tomorrow. Thanks. Bye.